What is your current assessment of the global economy and financial markets?
In the long term, I think we are in a new phase of deglobalization. And with deglobalization, of course, we have the two biggest countries in the world, China, on a strategy they call dual circular, which is to become self-reliant. And that, of course, recently have been met by the US and their CHIPS Act, which is also about self-reliance. In the short term, I think we need to solve for the dynamic trio wages, for goods prices, and energy. None of them, in my opinion, is on the downside. So this whole concept that inflation will flatten out and even reach between 2 and 3% as a target is not only naive, but it's not based on facts.
Everything we've seen in the past year in terms of the change in energy flows around the world, and I would say almost the way in which the West weaponized the financial system against Russia, we're now beginning to see the weaponization of energy against the West. And certainly, Russia has been doing that with natural gas supplies to Europe. We've then retaliated with embargoes against Russian oil. We obviously had the Nord Stream pipeline sabotage. So I've got to imagine that as strongly as you felt about this beforehand when we talked, I'm guessing the developments over the past year makes you even more confident that this heightened investment in energy going forward has to happen.
Yeah. So, if what is the main lesson from 22 in terms of the Ukraine and the energy side is that there is new alliances being built globally, and these new alliances have meant that in the energy sector, that the global trade routes have changed. As we closed down Russia at the end of last year, you can see that in mileage tonnage done on the shipping routes, they are now longer because we can't use accessible oil in Europe. And for the record, Europe continued through the Ukraine war to import oil from Russia, despite what the public sense was. But the real impact here is that someone like Saudi Arabia met up with China, agreed that now in the future energy should be traded on the Shanghai exchange in yuan, or alternatively as Russia in gold. Russia, India, Saudi, and China constitute an extremely powerful new alliances, which have aligned goals of not being dependent on the West.
Stuff's just going to get, secularly more expensive and to a certain extent more scarce, or at least harder to get than we've enjoyed for the past bunch of decades in the West. So this is kind of going to be like a slap in the face for us. Do you feel the same?
No, Sultan, of course, is far more eloquent than I am, but it's really based on the deglobalization concept. If you think about deglobalization as a concept, it's about the division of labor and the energy arbitrage. If you want to reverse that, you increase the marginal cost of labor and you increase the marginal cost of energy relatively to the input. And that is exactly what goes on. And I think the scarcity is given, considering that the way we solve for this is additional investment. And if we take a concept like electric vehicles, if people really want more electric vehicles, I wouldn't understand why we want that. But if people really want to drive through those by law instituted 2030, 2035 laws of decommissioning the combustion engine cars, then the demand on energy is just going to fly through the roof.
The higher cost of capital here and these factors I just rattled off, they're enforcing perhaps a much needed discipline on our capital allocation going forward, and that really the truly deserving projects now are going to be the ones that get that capital, and they're going to be the ones that lay the foundation for this future burst in growth that you're expecting in the future. Is that correct?
Increasing the threshold of investment takes away a lot of stuff that should never have been started in the first place. Secondarily, the way the flow will come from the microstructure is that companies will invest in stuff that has a real delivery in terms of improving the product. So I think you will see better quality products 5 years from now, and you see companies all of a sudden taking market share based on not having more eyeballs, but having more balls to do what is needed to create a better product.
I love that phrase. That's great, Steen. The Fed is basically going to war against inflation, and we're having a pivot. Back then, the pivot was from easing to tightening and hiking. That's going to be super material, and the market really is not pricing it in right now. And you were proved right in spades in 2022. I'm just curious, did 2022 unfold the way that you thought it would when we had that discussion a year ago?
It never does, Adam. I have to be honest. So Often say to rookies that even if I knew where the Fed's 10-year interest rate would be at the end of the year, there are so many paths by which we need to travel to get to there that it's almost impossible. I think a point being, although I expected high interest rate, I also expected commodity to do well. It did do well, but it did much better all the way into August, September when Fed started to hike the increments of interest rate. It's kind of interesting. Commodity came down while financial condition came down because but I have to put that down to people who are not really understanding fundamental economics.
Yeah.
But it played out in the sense that they stayed the course on inflation. There is still, in my opinion, a massive misunderstanding of financial condition and how wide that really is in scope and how much it actually is predicting what both inflation and growth would do going into the future.
How do you think we're going to avoid a recession this coming year?
People talk about recession as if it's a predefined concept. Everyone has their own definition of recession, like everyone has their own definition of welfare when you talk about welfare policy. So you need to qualify whether you talk about recession in real GDP terms or in nominal terms. So the US economy has a run rate of right now of between 6 and 7% inflation, which means that the top line of all companies in the US will grow by 6 to 7% automatically. Everything will not smell, talk, or act like it's in a recession, even though the real GDP may fall, because the real economy is driven in nominal terms, not in real terms. The real terms is only used for us economists to sort of get the price impact. I agree on the price recession in earnings, but not from the presumption that you make. I think what is really going on is what I alluded to earlier, is that companies now has to pass on the price increases in inputs to the consumer, which means that this whole drive toward productivity, better quality needs to be explained and needs to be acted on. But the recession is going to be that the margins will be cut, not because of cost of capital, but from the other side, basically because the cost of energy and the supply side remains relatively elevated.